Hello and welcome to Indianomics. On Tuesday, the Reserve Bank reduced the amount of capital that banks need to set aside to give loans to NBFCs and microfinance companies. Immediately, the cost of funds for NBFCs and MFIs falls, but the bigger message from the loosening of rules is that RBI seems to be determined to do everything to spur growth. Look at the sequence of events in the past quarter. First, on December 9th came the CRR cut, which brought in 1.13 lakh crore immediately into the system. Second, since Jan 1st, the Reserve Bank has infused 1.38 lakh crore by buying bonds through the open market operations, OMOs as we call it. Third, it started daily repo operations since January 15th to give banks temporary liquidity comfort. Fourth, it has done $5 billion of FX swaps in January and is doing another $10 billion swap on February 28. Together, they will infuse 1.3 lakh crore into the system. That's a liquidity increase. That's on the liquidity increase. On policy, we got the first rate cut, the first in 5 years, on February 7th, and finally, earlier this week, as I just said, lowering the curbs on loans to NBFCs. Now, separately, the Reserve Bank has also reduced prepayment penalties, and that can spur in its own way MSME borrowing. So now the big question, is all this enough to spur bank lending? More importantly, is it enough to spur growth, and will economists now increase their GDP growth forecasts for FY26? What more can RBI do? I have with me an elite panel, Mr. S.S. Mundra, former Reserve Bank of India Deputy Governor and former Chairman of BOB, now Chairman of Samman Capital, of course, Chairman of BSE as well. Suresh, Ganapathy, the finance company's expert from Macquarie Capital, and Nikhil, Gupta, the economist from Motilal Oswal. Gentlemen, thank you very much indeed for your time. Mr. Mundra, to you first, sir. A huge set of policy announcements, but most important is the last one, that the NBFC loans will now cost less. Do you have a confidence that Reserve Bank is going all out to improve credit growth, or should we look at it as a very incremental step? You know, if you can wear your DG hat, the NBFC's loan to NBFCs was growing at 30% in 2023. Now it has come down to 7%. We are happy, we have changed. This has got nothing to do with overall policy reset. How should we look at it?
Okay. First of all, Latha, I would look at it like this. Probably to my mind, at least I don't recall a series of events. It will be one of its points that the risk weight have been increased and then they brought down within such a short, window frame of the time. Normally, this kind of action is taken. It remains for quite some time, and before the things settle down. So, at least you may correct me, but I don't recall. So it means quite clearly the data point which are available to RBI and also the data point which are publicly available, there had been a sharp deceleration. RBI is surely, I think, looking to boost the growth. Okay. I look at it like probably the first action was kind of a message to the lending community. Lending community has responded to that message, as we can see from the data point. And now that action is reversed. So probably with the expectation that a message has been conveyed, and now this message would be kept in mind in the future behavior of the lender. So now it is for the lending community to stick to the discipline which has been brought by this. Mm-hmm. But coming back to the point, now with this kind of change in risk weight, I think around 40,000 crore of capital would be released, which can translate into 4 lakh crore of incremental lending. And now if you look at the other measures of providing the liquidity, because, okay, if you have the capital, but if you don't have the liquidity, then the end result would not be the same. So it's a combination that the capital is made available, liquidity is made available. Key question would be, to my mind, whether this incremental lending would go to the productive sector or it will go to boost the consumption. Okay. Nothing wrong in either way, but again, I think the lending going to productive sector is a more welcome situation. But then depends on what kind of demand is coming, what kind of confidence level that sector is looking at it.
Okay.
Consumption growth is fine, only the precaution, it should not again, result into making the people over-indebted,
Yeah.
which has its own set of problem. And then there could be, in the federal system, there could be actions by other players, which we have already seen.
That's
so
true,
I
sir.
stop it here, but
Okay.
this is how I look at this big
No,
picture.
fair point, sir. Actually, to be fair, the Reserve Bank has not reduced the risk weight on unsecured loans. They're very correctly giving a message that NBFC loans need not suffer anymore because NBFC sources of funds appear to have gotten more balanced. It was too dependent on banks. Now they have kind of corrected it and depending more on market. It seems to be the spur to consumption, at least I can't see it. They have still kept the cork on unsecured loans. But Suresh, for a more immediate, reaction, do you think we can see NBFCs as the biggest beneficiaries? Their margins improve and their loan growth improves. Can we come to that conclusion?
Yeah, look, all these things will take time, Latha, to play out, right? It's not going to be quite immediate because of the fact that the liquidity in the current markets are still pretty tight. So nothing is going to happen before the end of this financial year. And then, of course, you start off on a weaker footing on April to June because seasonally it's a pretty weak quarter. So all these things will take time. A point which I would like to just drive across on this 40,000 crores and 4 lakh crore number. Look, I mean, this is all notional calculation, right? See, at the end of the day, you have to understand that the system common equity tier 1 was already running at 13.5%. This only adds an additional 20 basis points, theoretically, right? You can anyways go down to 12-11% and could have lent that money. The bigger problem is that of demand and not of supply, to be very honest. At this point in time, the RBI is doing whatever it could do from the supply side angle. We really need to see demand picking up. And for that, we have to see what could be the implications of the tax cuts and how exactly the overall market responds to that. So, of course, at the margin, the NBFCs get the relief, but I would not really immediately pencil in growth numbers coming into the financial statements for either banks or NBFCs in the immediate future.
Well, Nikhil, question to you is that do you see all this as a concerted policy push towards growth? And therefore, are you changing your opinion, if not your actual number, on growth, say, 3 quarters down the line?
All right. So, no, I'm not changing my growth projections as of now. And I would also want to point out that, yes, if you look at all you mentioned at the beginning of this show, various steps that the RBI has taken, but we also need to understand that what happened recently is a part of the entire sequence. And you rightly pointed out that they have not touched the risk weightage on unsecured loans. Right. So this is a very targeted measure. They want to provide probably some relief to NBFCs and MFIs, which are too dependent on bank, and especially for non-PSL borrowings. It is PSL was never into risk weights were never changed for PSL borrowings. So it's only for non-PSL, and they are still keeping those unsecured risk weightage what they were revised to in November 2023.
That's right.
So it more looks like a targeted measure where they want to probably provide some relief for NBFCs and MFIs, not definitely to boost GDP growth or to boost the consumption-led loans. Overall, it is possible that all these measures may allow some extra room to the NBFCs and MFIs to lend out more. But again, if anything, it would be only incremental because I don't think NBFCs were too tight on supply front. They did not have money to lend to the borrowers if there was any demand. Because again, when I spoke with our NBFCs analyst, he was very clear that when in November 23, these risk weights were increased, the impact on NBFCs in terms of their cost of borrowings was not very significant. And if that is so, now when those risk weights have been reduced out, the impact would again not be so significant. So I'm not very sure if I would take it as a sign that credit growth is going to be much higher than what we were expecting.
So Suresh is not raising EPS estimates and Nikhil is not raising growth forecasts for the coming year. But why speak to an analyst, Nikhil? We have here a person who has lent loans as a banker and is still supervising an NBFC, which is lending loans for housing finance companies. So, Mr. Mundra, you know, how will a bank chairman or a bank MD or a NBFC chief look at the sequence of events? Will they press on the accelerator and lend more because they see policy in favor? Or do you think that the reality on the ground, I mean, you would know better, is the reality on the ground not such that loan growth will necessarily increase?
The NBFCs continue to remain an important cog in the wheel as far as the last mile lending is concerned. And I think for a variety of reasons, banks had also been finding it a good vehicle for their overall credit growth to keep on accommodating the NBFC, which has quite constrained, as you can see from the recent data point. So while I don't think that suddenly it will create a huge kind of enthusiasm that you just open the tap for NBFCs, NBFCs would also not be expecting that. But I believe that from the point where we are at this point of time, probably there would be a more benign attitude in accommodating NBFCs for their credit needs. And NBFCs would have that capacity, while Nikhil has mentioned some point of time, but I think is a diverse field. There are many players, but I think they would, it will enhance their ability to little push up their credit. So on both sides, on the bank's books as well as the NBFC book, I won't say it will be something revolutionary or something that suddenly a great change will come, but there would certainly be an incremental positive move from this. This is what my reading is.
Okay. Okay, point taken, sir. The other step that the Reserve Bank announced is that prepayment penalty will not be imposed on MSMEs under 7.5 crore loans. That will allow easier loan shopping by the MSMEs. Will these complex of steps, liquidity, rate cut and risk weights, create animal spirits in the lenders? That's the question we'll ask our guests after the short break.